It is September 16th. It is a Monday. And after I take you through the account, I will talk about how you could end up in a liquidity trap when trading options and what the dangers are in trading really far out of the money options, call spreads, put spreads, etc. All right, that's going to be the topic of today. So, going into the browser, I'm sitting at $69,000 right now. Pretty happy about that actually, because it's really close to my all-time high, which is, I scored it just this week, 69,617 or so. So I'm pretty happy about that. There's been a bit of a pullback. It's mainly due to that really crazy Apple options call that I did and exited too early. But I'm very thankful because it still got me $600 and I'm pretty happy about that. You can see the 1 year chart here. It's sitting at 34%, 3-month chart 10%, and 1 month an impressive 7% gain. So very happy about it. Now, in other news, precious metals got a bit of a pop. People are worried about Saudi Arabia and the oil situation there. If you haven't heard, I don't know the details, but apparently they got attacked over there and they had to shut down production, like half of their production or something like that, for a few days, maybe a few weeks, and oil got a huge spike. It was like 20%, and then it got down to 10% after politicians tried to calm the markets a little bit. So I don't know what's going on too much over there, but it looks like all the oil producers, all the oil companies will be benefiting, except Aramco, the Saudis, obviously. That's kind of how it is in the oil business. It's, actually all the resource businesses, really. If one resource provider is in trouble, the other ones benefit because their product will be more sought after since all the product is virtually universal. Like the element is the same. Let's say the element of silver, for example, is the same from in one part of the world as it is in another. It's not like consumers can choose which silver they prefer better, silver, right? So in this much the similar way, not exactly the same, oil is oil for the most part. I know there's different types of oil, so if you're an oil expert, don't jump on me, but um, they're all generally used for same purposes. So that's not my point. My point is that the other oil companies are going to benefit from this, and as you can see, they've had huge spikes. Now, gold and silver are worried because of these attacks, inflation, blah, 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 lower rates, etc. I do want to do a video on money mechanics and some revelating stuff that I've learned personally about how money works here and in virtually all around the world with the central bank spawned, currencies. But that's going to be maybe another video. Maybe I got to map it out a little bit because it's a very complicated topic. So anyways, back into the browser. Got so sidetracked. EXK was up $11. C-SPAN down 28. Apple up 208.19 after reporting really nice pre-order numbers for the new iPhone 11s. And I'm thinking of getting one too. I think the Pro version, I'll see. So all realty income is up $28, and I have the Russian market up another 21. Everything's pretty even. Uranium was about steady. Chemical down 90, but still not in trouble. Hovering at around the $960 level. It was up as high as 980. And as you know, I've been selling calls against my vast amount of shares that I've collected through options. And I've sold so far, I think 6 calls against my shares, as you can see right here, and I've been erasing some liability. Total return $2 my options right now. Today's 19. All right, so that's Cameco. Emerging market bonds popped up a little bit, and of course oil, etc. The market was down just a tad, So I'm beating the market by quite a bit today since I'm in the positive territory, 0.5%. Very happy about that. This is my watch list here. I've been looking to get into a lot of the stuff like the Korean market, some of these REITs, and of course I have the short-term treasury notes. I used to own EDF, no longer. So this is just my watch list. Now, let's talk about the liquidity trap that I was mentioning. All right, so I was just researching a trade that I want to do that's going to give me some decent return on maybe 1,500 of the dollars that I have in cash right now. I have about $1,700 in cash that I can use, investable cash in the Robinhood account. So I was researching how maybe to sell some either call spreads or put spreads on Apple, and I was just looking at the liquidity and I was trying to figure out if it's worth the risk, right? If it's worth the risk of me getting trapped without being able to collect my gains at some point. Because when you trade illiquid stuff like that, you might get trapped in it without an exit door, and I want to show you what that means. All right, so if we go into the browser here, I'm opening up Apple, and I was looking at some medium term to sell put spread or a call spread. Probably less dangerous at this point to sell a put spread, which means that I'm anticipating Apple not dropping by more than like $30. Okay, so I was looking at the November 1 puts. I tested the calls as well, and I'm thinking to give myself a $30 margin. All right, so the Apple stock is sitting at 220 right now. So if I go down to 190, I can sell a put at 190 here. And then I immediately want to buy a put right below it to make it a put spread. All right, so now if I continue, if I enter 3 contracts here, 3 pairs of contracts, preview the order, so you can see how I will get $120 credit for doing this, and I will have to put up for collateral $1,500. And that's all good and gravy. Expires on 11/1, November 1st. Now, that's all awesome, and if it executes at the desired price, that's great. However, what happens with these really out of the money trades, even though they're safer, and I'll probably be collecting that premium, and it's a really good percent return over that course of time, the problem here is that they're so illiquid, right? The volume for this was just 19, open interest 44, and so you can see how there's a pretty big difference between the ask and the bid. Now, what could happen, right? What could happen here with this is that, look at this one, volume just 1, open interest 6. So this is really hard to execute the trade, to enter the trade to begin with, let alone exit it. So what could happen is I may not be able to collect my gains ahead of time, which is something that people could do with a more liquid trade. So imagine a scenario where Apple goes up to 230, 240, and now nobody wants to trade options that are that far out of the strike price, right? No one wants to trade $40-50 below the price on November 1st, and so you have no market. Okay, so you're stuck. It's a liquidity trap, right? So let's imagine that you have some artifact from the 18th century or something like that, some weird baseball card that no one recognizes, but it's super. There may be like 2-3 people recognize even that it exists, and it's super value to them, and it's a historic card. But the thing is, like, no one wants to trade that, right? They're busy doing other stuff, more relevant things, and now to find the right buyer for that card, even if it's worth $1 million, is going to take you a long time, right? You may have to go to a very popular baseball auctions and try to get all this relevant. It takes a lot of work, and you can't even search for people to trade with in this platform, right? It's not like I can put a billboard, on Robinhood and say, for sale, put up 190 Apple put option. Come get your put option. Right? So, I can't even advertise it. I need like to convince one of my friends to go into Robinhood and buy it, right? Because literally no one's trading it. So even if the price is good for them, like $1, and it's totally worth to buy a $1 put for 190 because whatever, right? It's so inexpensive. It's like playing the lottery. But it might be, where you have a lot higher chance of winning in the lottery. So even if the price is right, I've picked the direction right, I may not be able to exit. So what might happen is that as there could be, I'm risking a price reversal. So let's say that $120 turns into $5 of liability and I'm ready to exit, and now waiting out the rest of the time, maybe it's a couple weeks, maybe more, for $5 is no longer worth the time. You get what I'm saying? So for example, like let's say it's a month option, and in 2 weeks I've gained 95% of the value of my trade. So it's smart to exit at this point, because whether I make 120 or $115, I mean, it's pretty much the same. Plus I can free up the capital. That's the more important point. I can free up the capital to enter another trade. So those 2 weeks are valuable, right? I don't want to waste them for $5. And so I want to exit the trade, but there's no one to take the other side. So I'm having to wait for 2 weeks. And even though it makes sense to the trade and it's lucrative and all that, it could be a lot better. And who knows what could happen in those last 2 weeks? Then maybe there's a big crash and now I'm taking all this unnecessary risk for $5, right? So anyway, that's a liquidity trap. So I just want to make sure that if you guys are considering doing something like that, like I am right now, that you understand that, and some of the dangers that you might encounter. It's kind of like a warning, I guess, video. But I, of course, I'm just a dude trying to make money on Robinhood and recording my progress. What trades you guys doing? Like, I want to know. And also, what else was I gonna say? Huh. I can't remember. But if I do remember, I'll make sure I mention it next time I'm on here. All right, that's just a little warning. That was kind of what was going through my mind. Hopefully, I find enough time to organize that currency video that I want to do and explain some of my findings to y'all. But until then, I have to say peace out.